How should you invest in the stock market during an election year? Major events tend to make investors a little uneasy about investing in the stock market. Not knowing who will run our country for the next 4 years and how their policies will impact our nation can quickly lead to a sense of panic or worry in the stock market. The word that many people throw out is unprecedented, but there's enough data about previous elections for us to discuss what is true about investing during the election years. And I'm going to share with you 3 things that I found that should empower you as a data-driven investor, and a little hint, the third one may surprise you. Let's look at the data. Fidelity posted an article showing how the US market has historically performed during election years. As we speak, we're currently in year 4 on the chart on the screen. The orange bar shows the minimum or lowest return historically going back to 1950, and the green bar shows the highest return. The first thing that should be noted is the wide difference in returns over this time period. Just in the year 4, the lowest return was around negative 40%, and the highest above 30%. That's a 70% difference between the lowest and highest returning years. So my first point is that anything can happen. Trying to time if this is the year for the positive 30% or if it's going to be the negative 40% can be really difficult. The second thing to note on this chart is that the average return for year 4 is 9.1%. This is pretty close to or in line with stock market averages. This is to be expected because the longer period of time that we have historically to look at, the more likely the returns will be, well, average. One interesting thought that Fidelity made in their article is that politically driven economic cycles are more relevant to emerging market economies or economies that have weaker institutions. They're not as relevant for developed markets like the US. In other words, the changes in presidency will not stop American companies from doing what they do, holding profit margins. And this logically makes sense. Although companies like Apple are impacted by changes in tax rates, import taxes, and monetary policy, they will not stop trying to be profitable businesses just because a different president is elected. Take a look at the chart again. If there was any takeaway to this chart, it is that in years 1, 3, and 4, the average return is fairly normal. But in year 2, before the midterm elections, the markets have historically performed the worst. Now, there could be a multitude of reasons for this, but what that potentially shows me is that the midterm elections could have a greater impact on the markets than the presidential election. And you want to know what also makes a big impact? It's you clicking that subscribe button. So if you aren't subscribed, if you could, click that subscribe button below. It really helps me out. Now, back to the data. In this chart, they show the average S&P 500 returns since 1933 going to 2022, showing different presidential parties and if Congress was primarily Democratic, Republican, or divided. Here's what I see while looking at this chart. Number 1, the stock market performs best when Congress is divided no matter what presidential party is in place. This is likely due to certainty. Investors know that when there's a divided Congress, it will be much harder for changes to take place that impact business in a major way. Number 2, the worst performing market is when a Republican president is in place and Congress is primarily Democratic, with an average return of 4.9%. Number 3, when Congress is primarily Republican, it tends to outperform than when Congress is primarily Democratic. So now we have looked at 2 charts that show averages, but I'd like to demonstrate the difference in return of past presidents. You can see in this chart that a large majority of the presidents experienced positive stock market returns, the largest being President Clinton and the second largest growth being President Obama. It's also worth noting that most of the negative years have happened with Republican presidents such as Richard Nixon and George W. Bush. If you hear anything in this video, probably the biggest takeaway from the data is that the stock market cares very little about who is in presidency, but it cares a lot more about economic growth and political stability. If there's a lot of uncertainty, the stock market typically tends to be more volatile than if there's more certainty. As investors, we should drown out the noise that the market will crash due to a specific presidency and invest for the long term, no matter who is the president. Have a plan, stick to that plan. What other takeaways do you have from this data? Let me know in the comments below. And just as a reminder, you will lose money in the stock market. So watch this video on 3 ways to combat that.